Steve, the Meisner, how's it going, my friend?
Good, James. How are you?
Well, you know, I'm a little bit pissed off. These super voting structures, these large cap companies who are U.S. multi-state operators coming and listing on the CSE with these multiple voting share structures where, you know, a couple of insiders are essentially controlling the destiny of the company and the shareholders really don't have a vote. Wasn't it you who was telling me that back in the 90s, the super voting structures were basically drummed out of town, off the market and everything? What was it about super voting structures that you money managers didn't like?
Well, specifically the relaunch of the multi-voting structure is due to obviously in the cannabis space, and that's where we're seeing the resurgence, and it's not ideal, that's for sure. I don't know that all the multi-voting share structures were drummed out of town, but it became a big issue with corporate governance. It seemed if the idea of a corporation and one vote, one share structure is pure democracy in its rawest form, then multi-voting is inappropriate.
It's a dictatorship.
It is. It is. And it allows individuals to dilute and issue more shares without losing their control position. So a lot of the share structures were collapsed due to shareholder vote and due to institutional governance and pressure from institutional shareholders. So that's how that's how a lot of it disappeared, but it didn't all disappear.
Sure. So give me an example of the most egregious form of corporate behavior in the super voting structures from a past example.
Well, I would say Magna stands out. In the early 1990s, Magna allowed Mr. Stronach to control the company with less than 1% of the issued equity of the company, and still does to this day, to my knowledge. I think that's unfortunate. In the early 1990s, around 91, when interest rates went really high, Magna was essentially a bankrupt entity, and the bondholders had to do special votes and give special concessions to allow the company to stay in business because they were in debt default. Sadly, what the debt holders did is they did not insist at that time to collapse the multi-voting structure, and Mr. Stronach was able to hang on, and that's going back 28 years ago, which is quite amazing. But that really, and that allowed Mr. Stronach to go into racetracks and entertainment and things that maybe were outside of the venue of auto parts. And notwithstanding, it's quite a company, but it doesn't seem appropriate that he can control the company with really such a minuscule stock position. Mm-hmm.
So is there a risk that the large cannabis companies who are governed by these super voting structures, is there a risk that they could decide to go into horse racing too if there's some weakness in the cannabis space that spooks them and equity investors won't actually have a vote to stop that?
It's true. I mean, they essentially have dictatorial control. The two big ones that went public in the U.S. just in the last month, they both ended up with about between 82 and 84% voting equity after the issuances of at least $300 million US in each IPO case. Mm-hmm. And the one individual or a handful of individuals control 84% of the stock. That's pretty compelling for them and not for shareholders. I think the excitement of the space and to get all those multi-state opportunities allowed the shareholders to maybe overlook that structure, but it's not ideal, and
mm-hmm.
it arguably is not ideal for maximum valuation in a stock.
Sure. So is it your position that retail investors should stay away from super voting structures given all other things being equal in a basket of stocks they're considering as an investment?
I think it's a component of consideration, and it's not ideal. Now, there are some major institutional businesses in Canada, that major institutional companies or institutional grade companies that have multi-voting or non-voting stock structures, typically in the Canadian media space. Now, it was argued, and they were still grandfathered or accepted by the market, it was argued that that was to protect Canadian media companies from hostile foreign takeovers by American or international entities. So companies like Rogers have voting stock, which the family controls, and non-voting shares. Shaw has non-voting shares or sub-voting shares, and that was more typical. And when McLean Hunter was public, they had X and Y shares. So there is some legacy of these sub-voting stock or sub-voting stock companies around in Canada, but really leftover. Canadian Tire is one that's most interesting because it goes back probably to the 1930s or 40s, where the Billes family took the voting stock, and the shares that trade for the both classes in Rogers and Canadian Tire case, they both trade, but the liquid one and the one that's widely owned is the non-voting shares. What they do offer, though, is they offer this coattail provision. I haven't looked at the U.S. cannabis companies. I'm going to assume that's in there, but that's in the event of a takeover of the company that it's called a coattail provision, which should allow the non-voting shareholders to get exactly the same price per share as the voting shares. Yeah. Now, Canadian Tire doesn't have that, and there was a controversy some decades ago when they tried to sell the company, and the price spread between the common non-voting and the super voting shares was dramatic, and that the deal ended up failing.
So I'm looking at the case where so the coattail provisions do exist in the U.S. operators who are Canadian listed, but the weakness in the coattail provision says that just because an offer is made for the super voting class does not necessarily mean that the shareholders get to vote on the adequacy of that offer. However, they will be subjected to the same takeout price if the super voting holders get to actually approve the takeout offer.
Yeah, I mean, each structure is different, and it's going to be in the fine print of the prospectus, so I don't know specifically, but typically it will be a case where management recommends to shareholders that this is fair and this is good and you should take it. But I don't know for certain in each case, and each case may vary whether there's the privilege or the right of the subordinate voting or the non-voting shareholders to vote. I think the new deals that have come in the cannabis space are actually subordinate voting, so you get a vote, but there are super shares that allow multitudes of votes to overwhelm and dilute out the value of a single vote.
Yeah, I don't know about you. I'm going to stick with the companies without the super voting structures, but thanks, Stevie. See you later.
You bet, James.